Entering the heavy construction sector requires an immense capital commitment. A mid-size Caterpillar excavator costs between $150,000 and $350,000. A heavy-duty dump truck adds another $300,000, while a concrete batching plant can price out as high as $588,000. To bid on large-scale commercial projects, contractors are often required to have over $1 million worth of equipment on their lot before they even break ground. This chart shows the industry's central paradox. While the blue line shows the sector added $890 billion in value in 2025, the red line shows that 80% of construction firms fail within 2 decades, largely due to cash flow mismanagement. Draining a business bank account to purchase machinery outright creates an unsustainable risk. This is why 79% of companies maintain their liquidity by utilizing equipment financing instead of cash. This cash flow trench represents the mobilization gap. When a contractor wins a $2 million project, their cash reserves don't increase. They immediately plunge as the work begins. Upfront costs pull the reserves deeper into the negative. Surety bond premiums take 1 to 3% of the contract value. Material tariffs on steel and aluminum sit at 25 to 30%, while construction wages are currently rising at a rate of 8 to 12%. Structural delays prevent a quick recovery. It often takes 60 to 90 days for the first progress payment to arrive. Even then, project owners typically withhold 5 to 10% of the total as wickanage, a portion of the profit that remains untouchable until the project is fully complete. The construction industry is structured to punish cash-heavy operations. To survive the mobilization gap, contractors require an external liquidity shield to maintain their working capital. Alternative equipment financing is accessible because the machinery itself serves as collateral. The value is locked into the iron, not just the company's credit history. Because the asset secures the loan, underwriting is flexible. Lenders accept credit scores from 550 to 700, often require no down payment, and can provide approvals within 24 to 72 hours. This financing covers a wide range of assets, from a $35,000 mini excavator used for residential trenching to $350,000 mid-size units for commercial site preparation. This capital allows contractors to acquire equipment from leading brands: Caterpillar for hydraulic power, Komatsu for autonomous solutions, Volvo for safety standards, and John Deere for integrated telematics. Using the machine as its own collateral transforms equipment acquisition from a cash-draining liability into a leveraged asset that generates revenue from day one. Most equipment loans range from 3 to 7 years. However, the advantage of alternative lenders is their ability to align repayment with a contractor's actual revenue cycle. With seasonal payments, loan obligations match the business cycle, higher during summer peaks, lower during winter slowdowns. Deferred options go further. Delaying the first payment 90 days lets contractors navigate the mobilization gap entirely, using project revenue to pay for the machine. When debt service is synchronized with incoming revenue, the threat of default during lean months is significantly reduced. Fleet management is governed by utilization rates. To justify owning a machine, it must reach a utilization threshold of 60 to 70%, roughly 150 to 200 days of work per year. This leads to the Core Plus Flex strategy. Contractors finance their daily use machinery, like excavators and loaders, to build equity. Specialized tools, like hydraulic hammers or boom lifts, are rented only when a specific project phase requires them. Following this utilization math prevents contractors from paying monthly debt on idle machinery, maximizing the overall return on the fleet. The tax environment for construction firms changed in July 2025 with the passage of the One Big Beautiful Bill Act, or OBBBA. For 2026, the Section 179 deduction limit has been set at $2,560,000. This allows businesses to deduct the full purchase price of equipment in the year it is acquired, with phase-outs not beginning until total purchases reach $4,090,000. The most significant provision is the reinstatement of 100. Equipment financing acts as an operational shield, protecting cash reserves, neutralizing the mobilization gap, and utilizing the U.S. tax code to maintain a sustainable, high-capacity contracting operation.